in the bond market is an interesting one, Guy. But I would say that because the long end went up, it was more of a reflection that the bond market's pricing in higher future growth and inflation, essentially saying that maybe Powell is stepping into, admittedly, a very small mistake by easing financial conditions, easing monetary policy, thereby accelerating potential long-term growth and inflation.
So bear steepening, in other words,
Correct.
from the long end, is something that ultimately could say that the Fed has moved too fast.
Moved too fast. Yeah, right. Absolutely.
So that means that there is a risk potentially of reinflating the economy?
I think that is the risk. I think that's the thing that no one's talking about. Everybody is wondering, seeing the unemployment rate going up and is so focused on an economy that's weakening, instead of maybe saying, hey, maybe we're just going through normalization and we're actually going to reignite growth here.
Yeah. Is that a concern of yours, Karen? I mean, you see rates come down and, consumers step into the housing market. All of a sudden, the rates on the credit cards are lower. They might buy more. I mean, these are real risks.
Right. But I think that, you got to titrate a little bit, right? We have room for that. I think, just to pick up the sports metaphor
let's keep
again.
I'd like to keep this going all night.
This is my forte, so let's go.
All right. So where's the puck going? The puck's going inflation lower, unemployment higher.
Right.
Right. And so I come back to that as a good support for the 50 basis point cut. I'm not so focused on. We want some of these things to ignite, right? We need help on the housing market. So you need to have rates come down to get all that stuck existing inventory out.
But why are you so convinced that unemployment is necessarily going to continue to go up? I mean, corporate profits are broadening and look great. I mean, who's laying people off at this point?
I also think that the rise in the unemployment rate is misleading. I think the participation rate's gone higher. The separations haven't necessarily gone higher. The job opening dynamic is yes, it's a leading indicator of the labor market. But right now, I don't think the labor market's falling apart. And it's interesting, though, that the Fed is different from June, where they were 4% year end on the unemployment rate, and now they're between 4.2 and 4.3. So clearly a more bearish tack. I think the market paid attention to that, too.